Good evening. Hi, it's Ross McInnes from Australian Investment Research Services. Thanks for joining us. At the start of the week, we were looking for global markets to stabilise after the capitulation type moves last week, which had the Australian S&P 200 index down 15% last Friday morning at 4175. This week, the market still very jittery and very much like the March quarter 09, where there still was a major uncertainty about the future direction of the global economy. And we saw the markets on Tuesday night sell off very heavily and then recover and then bouncing off news stories as they came in. The big news story that got the market unsettled midweek was the Chinese potentially, or leaked of a story, the Chinese potentially going to sell part of their Eurobond portfolios. On Thursday afternoon, though, they denied this as anything in their policy. That was via a press release from the People's Bank of China. And this has allowed the market to rally into the close so far, the Asian close for Friday at least. And the S&P 200 index has closed up 3% this week, just over 4,400, or at 4457, and that's at about a 10-day high. This was driven, two major parts of our stock market, the Australian stock market rallied, materials and the banking sector, both up over 5% this week, after being heavily sold. The resources got some relief from the fact that rumours or stories in one of the big newspapers, the Australian newspaper, that they may change the design of the new resources tax given the animosity that was driven out of the market from it, and they may be changing the risk-free return that's inside the calculations, which is presently at the 10-year bond rate, but there seems to be pressure for it to include some sort of risk weighting as well. So we're waiting on more concrete details than that, but it definitely gave the Australian market a leg up. In terms of Wall Street, similar story, got down to 1,040 on Tuesday night, which was a 6-month low, but it managed to stabilise from there, and at the moment it's trading above 1,080, which was our key pivot point for the week at 1103, and we're looking for the next overhead at 1120, which is what we mentioned just then. Okay, so we're in a position where our research was suggesting that the European situation wasn't quite as bad as maybe the market was factoring in, and that's so far proven the case. Tonight we've had the EU support the Spanish austerity measures that they've put through Parliament as a function of that. And it's still going to depend on how people, or whether people like OPEC over the last 20 years, whether they believe the Europeans can actually deliver what they're saying they're going to do. So again, it's going to be a fluid situation, but it does appear that the Europeans' growth may be affected by what's been going on with fiscal policy, but unlikely to throw the economy into reverse gear at this point. This is also reflected in the Australian dollar, which on Tuesday night got down to 80.60, which was a 10-month low, but from here it managed to stabilise thanks to some offshore buying. This afternoon it's rallied very strongly after breaking 83.50 yesterday, and it got to 85.50 weekly highs, sort of in the European opening. It's back down at 85.10 at the moment. So what we've seen is the markets had their first leg back up after extreme pressure early in the week, and we look for the Aussie to have potential for further upside over the next week or so, but a big week ahead for Australian markets with the RBA, March quarter GDP numbers, and the next run of retail sales and building approvals numbers to be watched. We'll talk about this more on Monday morning when we do our week ahead report. And the other thing, just for everyone's guide, is that we had the Australian interest rate market looking for an easing in the December quarter only 48 hours ago, and this has significantly changed with the recovery in equity markets, and we've seen the market come back to a more rational view that it's unlikely that the RBA is going to ease. In this respect, the 3-year bond futures contract sold off 20 points back to 4.8% from 4.65, which represented a 5-month low in yield. So that's where we're at the moment. Still, markets have recovered reasonably well, but obviously there's still uncertainty and noise to come out of Europe, given that they have had a major shock in terms of expectations and sentiment there over the last 5 weeks. led by the Greek bailout. But we do see that the position is probably going to be reasonably stable longer term, especially when we see that the Asian data is so strong at the moment, and the exports, particularly in Japan, Korea, Philippines, and so forth, have really suggested that intra-Asian trade is going to be a source of growth for the region and also for the global economy as well. So thanks for your time, and we'll speak early next week. Bye bye.